Hello and welcome back to yet another exciting week on the stock market. In this week's episode, what is the kangaroo market? I will try to explain this rather non-official term, but nonetheless, let's take a closer look at that. Then we will look into the financial news for this week. Then we'll take a closer look at the portfolio and see what has happened. And finally, I will answer some questions which I have received from the audience. So what is the kangaroo market? Well, first, let's describe the two official terms that you have for the state of the market. You have either a bull market. A bull market means that the market is up 20% from its recent lows. The reason why you use the term bull is because when a bull attacks, it starts with the head low and then it lifts up. That is, at least from a historical standpoint, how you originally have defined a bull market. On the other hand, if you have a bear market, the reason why you use the term a bear market is because a bear, when it attacks, it starts with the claw high and then it lowers the claw. So a bear market is if you have a market which is down 20% from its recent highs. And then we have this unofficial new term which we are currently seeing, the kangaroo market, meaning that the market is bouncing back and forth between these two limits within plus minus 20%, and it's doing it with bigger swings than what we usually see. So in essence, we are seeing more volatility than we are used to. I will of course include a link in the description below to where I found this picture from CNBC, where some other people have said that they can't determine whether we have a bear market, a bull market, or a kangaroo market. And I just thought it was actually quite funny to see, and it also goes very much hand in hand with this investment philosophy of dividend growth investing, since Warren Buffett and Benjamin Graham would say, well, I can't predict what the stock market is going to do tomorrow or a week or 2 weeks from now. But what I know is in 30 years from now, the market will be up. So when you're seeing the big medias using the term a kangaroo market, they're literally saying we can't predict it. So this again just confirms to me that this is a good strategy to follow about being a long-term investor. So let's look at the news for this week's episode. I will of course include a link in the description below, since I'm going to talk about Jerome Powell and the speech that he gave this week. There will be a link to the CNBC YouTube channel where they are showing his speech, and then I will also include a link to the official Federal Reserve webpage so you can see all the questions there. The interview is about 10 minutes long, where it's only his speech, and if you include all the questions, then it is an hour. So without further ado, let's jump into the speech and see what it actually contained. So Jerome Powell highlights that there is a big uncertainty in the US economy in the short to medium term, and that they are working with a lot of different scenarios, and they don't even have one scenario which is the most likely one. They are simply preparing for all the different ones, since they can't predict what will happen. The only thing that they do know is that ultimately we will have a full upswing of the economy, but he don't put a time estimate on this. And they are announcing that they will keep the rates low at least to the end of 2022, unless the economy has recovered faster than that, but that is not expected currently. On the other hand, they are still saying that they are not going to lower the interest rate to below 0%. He then highlights the very important point that the Federal Reserve has lending power and not spending power, meaning in case the households needs liquidity, well, then it's up to the Congress to provide that. The Federal Reserve can only provide liquidity to the businesses where they expect to be repaid some point into the future. Then he addresses the consensus in the market regarding a historical big drop in the BNP for the second quarter. But after the second quarter, they expect to see an upswing in the economy, and as an overall prognosis for 2020, they expect a drop in the BNP of 6.5%, and that the unemployment rate will go to 9.3%. and this is from the current level of 13.3%. However, there's one caveat here. He then addresses that there is a big uncertainty simply due to the way that you're calculating these numbers, so they might be a bit off. And then, given the uncertainties already mentioned, we see an estimation for 2021 where the Open Market Committee indicates an economic growth of 5%, and they expect that the unemployment rate will go down to 6.5% by the end of 2021. Whether that will hold true, we will simply have to wait 1.5 years to see, but it is at least reassuring that they think the economy will go up next year. He also addressed the question of whether or not they were going to use yield curve control, and currently they are still investigating to see if that actually fits with the tools that they are already using. But again, they have highlighted they are willing to do whatever it takes, so it will be quite interesting to see if we will actually see yield curve control in the near future. So that covered the financial news for this week's episode. Now, let's take a closer look to my portfolio and see what has happened within the week. So let's start by addressing the fact that this week we have seen the biggest drop on the stock market, at least on the Dow Jones Industrial Average, compared to what we have seen since March. So it will come as no surprise that my portfolio is also severely down in value. This is also clearly indicated with the red circle for this week's episode. I'm actually down $5,100 if you just look to the value, but since I have added $500 extra into the portfolio, I'm actually down $5,600 for this week. So it was actually in the light of my own portfolio where I lost $5,500 this week compared to the gain that I had the week before of $8,000 that I thought this concept of a kangaroo market would be funny to talk about. So if we look a little closer to the market movements for this week, we see that 3M has become negative compared to last week, Pfizer has become negative, and Starbucks Corporation has become negative compared to last week. So now I only have 3 companies which actually has a positive market gain compared to when I have bought them. So what should I do going forward from here? Should I consider adding more money into those companies, or should I buy new companies? This week I decided to go and buy a holding in a new company, so I have added $500 into Verizon Communications. So why did I decide to add Verizon Communications into my portfolio instead of just adding more into one of the companies which I already had? Well, first of all, I wanted to have more exposure to the communication service sector, and since I currently only have Disney, I wanted to add at least one other company into that sector. So that was my reasoning behind adding Verizon in the first place. You could of course argue, well, there's a lot of companies in the communication service sector, so shouldn't you have added AT&T instead? Sure, you could have that argument and say, why should I choose Verizon over AT&T? So why did I choose to buy Verizon instead of AT&T? Well, if you go to Yahoo Finance and go to the financials and then go to the balance sheet, so here we can see that the total assets of Verizon is bigger than their total liabilities. That is a positive sign. But if we go and do the same for AT&T, we can see here that their total assets is way bigger than their total liabilities. So this would indicate that I should actually prefer to buy AT&T instead of Verizon. But if we then go and take a closer look at the income statement, here we can see that the total revenue of AT&T is $181 billion compared to a cost of revenue of $84 billion. If we then do the same for Verizon Communications, we see that they have a total revenue of $131 billion compared to a cost of revenue of $54 billion. So Verizon is actually better at making profit than AT&T currently, since they are paying less per dollar of profit that they are making. So when I looked at this metric, I at this point in time prefer to buy Verizon. This is not to say that I wouldn't consider buying AT&T in the future, and I could very well consider buying AT&T to diversify my portfolio, but this was at least one strong argument for me to prefer Verizon at this point in time compared to AT&T. So this is by no means an in-depth analysis of why you should prefer Verizon over AT&T. This was just to show some of the metrics which I look at when I decide which companies I want to add into my portfolio. So let's take a closer look at the dividends which I have received this week, since I have received $23 from Pfizer and a little more than $11 from ExxonMobil, bringing the total dividends so far for this month up to $91. So again, the portfolio is contributing into the continued growth of the portfolio, which I'm still very happy to see. And while we are on the topic of dividends, I have to announce that Ford has cut their dividends, and they did that far back in time, but unfortunately I forgot to update that. And the same story goes for Simon Property Group. At least when I go and check into Seeking Alpha, I can see that I'm not going to receive any dividends so far. They have cut their dividends back in February and haven't announced anything new. And since they are supposed to pay once every quarter, I expect that the dividend is completely cut. So that covered the update on the portfolio for this week's episode. Now let's go and take a closer look at some questions which I have received from the audience. So the first question goes like this. Hey LMG, I'm 18 years old and is just getting started with investing. What should I invest in? So first of all, thank you very much for the question. Second of all, well, this is really a broad question, but at your age, I would suggest that you invest in yourself, meaning acquire some skills which will be very useful for you. Whether or not you want to pick individual stocks should depend on your willingness to spend time learning about accounting and other financial skills which would be useful in case you want to pick individual companies. In case you think that accounting is boring, then I would highly recommend that you don't pick individual stocks, because if you don't want to look into quarterly results or yearly reports, well, then you would perhaps be better off by just investing in an index fund or an ETF, since then you will get a return which is more like the market, and that would probably be the best investment you can do, since then you can spend your time on something else and perhaps increase the amount of money which you're capable of saving and still receive a good return on your money. So that covered yet another exciting week on the stock market. It is actually so exciting currently that we have to invent a new definition of a kangaroo market, since we can't decide whether it's a bear or a bull market. So a new definition had to be invented in this bumpy ride situation. So remember to comment, like and subscribe, and until I see you next Sunday, bye!